we are in an inflationary environment for the next few years, if not for the full decade.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Lior Ganz. He's the founder of wealthresearchgroup.com. Welcome, Lior. How are you doing?
I'm doing well. Thanks for having me.
You're welcome. So we were just speaking before we started that things are changing so much that it's difficult to know what to talk about. So why not start with what's going on here in Europe right now with energy prices, and also here in the UK. I've been following this very closely the last few weeks. We're seeing government bond yields go through the roof here in the UK. Almost like there's another sovereign debt crisis like we had 10 years ago. So maybe you want to start with that.
Absolutely. I think what happened in Europe goes back to the early 60s when Germany was divided into East and West, and there was a deal struck between the USSR then and the western part of Germany, and it was whatever the Germans had to export to Russia in exchange for oil, natural gas, and that's when the pipelines started to be laid out throughout Europe, and that dependency between Germany, which was literally the barrier between East and West in the world, and the USSR became so problematic when you look at it in hindsight right now, right? Because Russia and Germany are very codependent, whereas militarily they're at odds with each other. So that is not a solvable problem, definitely not solvable in the immediate term, because just like a railway system is sort of permanent, so are pipelines. The entire reason that the USSR laid out these pipelines that go from Siberia through Ukraine and Belarus towards Europe is because they have very limited port industry. So they're deep ports where you can put oil tankers and take them via the sea or the North Sea or the Black Sea, and then through Turkey to Europe. Those infrastructure are just non-existent. That's why the Donbas region with that area, that access to the sea, is so important and crucial for the Russians, because the pipelines go through Russia, but then they go through other sovereign nations which used to be part of the USSR. So you have that problem. That problem is not going away. Then the second problem that they had was that once the USSR was falling apart, the Caspian Sea, where the sea, the floor, the bed of that sea is the most richest in the world in terms of natural gas. It was divided by 4 countries that in the days of the USSR were irrelevant countries, basically, but then became very rich countries with very small populations, and they've never been countries that functioned before. So the West immediately came in, struck deals, and overrode Russia. So you're seeing this has been playing out for 30 years, and now it came to this culminating moment where Putin actually went ahead and started a war. So I think to fix the relations between Russia, Europe, and the Ukraine, you're talking about a decade, if not more. New deals, new relationship. It's definitely a reset geopolitically in Europe. And so the energy crisis that's going on right now, I think you will see it linger on. There is no immediate fix to it. And what's going on basically is Russia selling to third parties, and then the third parties are selling back to Europe, so that there's no direct sale between Russia and Europe. But it's still a big problem, and it's going to be handled, but it's going to take a decade. So the energy crisis in Europe is real. I think it's going to be something that stays with us. And it's not only that particular problem that Europe is facing. I think they're facing a problem with their currency. And overall, I think we're going through a big reset, not just in Europe, but in emerging markets and in the developed markets as well. So the big picture is much larger than just the Russia war. But I do want to just point out two more things about the Russia war. One, transportation. There's a lot of transportation that goes through China, then Russia to Europe. Those routes are very much disrupted. That continues to play a problem on supply chain. So it's not just the supply of energy per se, oil and natural gas. It's also the transportation lines and routes that go through Russia to Europe that are problematic, and of course the Ukraine.
So it looks like Europe has, and the UK for that matter, because all these prices are set in an international market, have been really complacent about all this situation. They've let it fester, and coupled with the fact that this cheap energy that we've had up until recently provided like one of the pillars for Europe, the UK, and even the US to inflate their systems with funny money, QE, low interest rates, and it seems to all be connected. I spoke a couple of days ago, actually, in my video about this and how the era of easy credit is over. And maybe you could talk about that factor there compared to the energy crisis, the fact that all the rising interest rates are not just because of energy, but because the fact that it's really going to be difficult for central banks now to inflate, and maybe creditors want to have their, they want to have their pound of flesh, so to speak.
Yeah, that's the best question I've been asked for a while. I don't know if you can see my name, like my screen name, but it's you can see wealthresearchgroup.com/ZIRP, which is this special report that I created especially for your viewers, and it's literally on this topic. So that was going into this interview. That was the most important interview topic for me to touch on this interview, because I don't think that people or Wall Street, for that matter, truly realize how much the era of ZIRP, which is zero interest rate policies in an acronym, is over. Because it is. The consensus on Wall Street is that the Fed is going to raise, get to a point where the reason to keep raising is diminishing. In other words, you keep raising rates, it gets diminishing returns, you get way more problems than solutions, and then they start cutting rates back down. That was like literally the consensus on Wall Street. You raise, then you cut in 2023. I don't think that the market truly realizes yet. It's starting to grapple and understand the real truth, basically. In Jackson Hole, Powell really laid down the truth for the first time. And, in this answer, I'm not going to get into, I can't get into everything. So I'd love for the viewers to definitely download the, /ZIRP and really understand this topic, because it is the most important investment topic of the next 10 years. The end of ZIRP, you cannot expect the central banks to go back to zero interest rates. There are three main reasons for this. One, it's the unpopularity of ZIRP. In other words, in the minds of the public, the reason we have inflation is because of funny money and easy credit. So the most unpopular thing, the things that will get chairmen of central banks and governors fired, resigning, and put under more pressure, is going to be speaking out in terms of more dovish central bank policies. This is not happening. It's just like trying to hand out giant bonuses to Wall Street bankers right after the great financial crisis. It's the most unpopular thing you can do. So that's reason number one. It's simply, in the eyes of the public, it's a suicide to go back to dovishness from the central banks. The governments, they're going to be very dovish. But central banks, no, and I can talk about the governments. But okay, so that's reason number one. Reason number two is and Powell gave it out to you in the Jackson Hole speech. He said, we will not stop until the job is done. What does he mean by that? He means that in the mid-1970s, the central bankers believed that they had inflation under control. And then they eased and inflation erupted again. They will not do that mistake again. They will basically make sure that just like when you try to kill a mosquito or something, you pound that thing like a gazillion times. Sometimes I see people do that, even though it's gone, but you're like scared. It's the same thing. They will overshoot in terms of what they will do. They want to make sure the job is done. They're not going to see 2 months of declining CPI and just stop. They're going to go on and go on and go on. And then once they're assured, they're going to keep interest rates higher for longer than the market currently realizes or prices in. And it's this whole debate, Mario, between when do they know that this is transitory and when they told the public. There's a gap there. At first, they did think it's transitory, but just because they were surprised themselves of what's going on. But once they knew, they didn't want to panic the public all at once, or Wall Street for that matter, or small and mid-sized businesses. So they waited. They let reality kick in, and then they admitted it. And I did a very nice report on this matter. If you want to check it out at wealthresearchgroup.com/know, and as in KNOW, because there's a real gap between when the Fed admits something and when it's actually already priced in the public. That's behind the curve and ahead of the curve or on the curve. Those are the terms that people use when they talk about this. But I think right now, what's happening is Wall Street and academics are starting to realize we're probably going to have interest rates at 3 or 4% for years and years. Who's not understanding this yet is households, because if you ask the average person, he's saying he's waiting to buy a home until mortgage rates come back down. And that means he's not even thinking about the possibility that that's where they're going to stay. Small and mid-sized businesses, I think they're still not getting, or mom and pop America, half of the GDP is still not understanding that this is going to stay with us for years. So to me, that's the biggest misconception. That's the topic that people need to realize, and that's why I wrote that report for you viewers, because once you realize that, your delusion that this is going to be the same as the last decade is over.
And do you think they can really quash inflation with 3 and 4% rates? Because in the 70s, eventually they had to go to 20%. And back then, the debt to GDP ratio was like 35%. And now it's like 130%. I don't think... I mean, I saw a comment by Bostich. He's the Atlanta Fed president. Mm-hmm. He said, "Oh, if we see that CPI is dropping and has stabilized, we will reverse the 75 basis points hikes." So, okay. How do you really think they can really kill inflation with so much leverage and debt in the system, even compared to the 70s?
So my opinion is that Paul Volcker and what he did is the exception to the norm. Normally, the Fed does not control the overall trajectory of interest rates or the economy. It's perceived that they have that power, but literally very few Fed chairs have actually exercised that amount of power. They can have that power, but it takes something like what Paul Volcker did, where he raised interest rates from 10 to 20 overnight. I don't know that we are in that situation right now. So that's step number one. In my opinion, there are just big trends at play that are creating this inflation. So just like there were big trends at play creating deflation, and for a full decade, the Fed wanted inflation to be at 2% and they couldn't get it to go there. Just like that, they will not be able to take it to 2% during this decade. It will stay above that for the entirety of the decade. So unless there will be a Fed chair as aggressive as Volcker, and I don't know that we can count on that. Okay, so that's the first thing. Secondly, In the 1970s, compared with today, you had a big difference. If you look at 1971, the 15th of August, so basically around 51 years ago, and 51 and 2 weeks ago, Nixon took us off the gold standard. That was a true change of monetary policy around the world. And that unleashed a lot of inflation. We have not seen a change in monetary policy as dramatic as that during even the pandemic. True, there was stimulus checks and unprecedented backing of the economy, where the Fed said, hey, we'll buy all the junk bonds in America if we need to. They ended up not buying anything. But I don't think that the comparison in terms of what we're not seeing is as big as what people missed in the 70s. So that's secondly. The third thing that I think is a big difference is what's called inflationary expectations for the public. When the public starts, when households and small and mid-sized businesses begin to factor in inflation in everything that they do, you have what's called unanchored inflationary expectations. And that's what happened in the 1970s. When you were thinking about vacation next year, your rents next year, your education bills, your this bills, when you were thinking about wages for your employees, everything went through this idea that, hey, it's going to be more expensive next year. It's going to be more expensive next year. And you factor that in. Now, when you start to factor that in, you cannot build a real business or sustain a real household because you're concerned with inflation and not with true growth and true value. So we still don't have that. Right now, if you look at the University of Michigan surveys, which are the best in the world, the average American believes that there's an inflationary problem right now. He thinks it's going to linger on for another year, but then he believes it's going to get solved. So inflationary expectations right now are very much anchored compared with the 1970s. If that changes, we're in bigger trouble. But for now, you're in that area where if the Fed continues to do what it's doing and it will continue to work, then we will not get to double digits inflation on the CPI, and we will probably just start to come down. But still, like I said, there are big demographic and geopolitical and other type of huge trends happening that are inflationary in nature, and they've all erupted at the same time, probably because of the pandemic and the response to it and how chaotic it was. But yeah, we are in an inflationary environment for the next few years, if not for the full decade.
And do you think the Fed will be able to get real rates back to like zero? That would be a start, because right now with rates, I don't know where rates are, just below 3%, the Fed funds, and we got CPI at over 8. That's like -5. And in the 70s, I think they had quite a bit of negative real rates, but they were eventually able to get above the rate of inflation. And the Wall Street, the people who still think, a lot of people still think that when the recession comes, the Fed will cut again and rates will even go to zero. These people look a lot at these break-evens, 2-year, 5-year inflation break-evens, but these have been completely wrong. So how do you see that panning out?
I think eventually we'll get to zero in real rates, but I don't see that for another 2, 3, 4 years. We are living in a negative real interest rate environment. But I have to say, Mario, with that said, it's not the experience of most people, investors that is, that they are living in that environment. And I'll give you an example. My hedge fund manager, for example, just lent money to American Airlines at about 10%. So the bond market is exiting the era of TINA, which is an acronym for there is no alternative, where you had borrowing costs very much pegged to zero, and therefore stocks were the only game in town. What you're seeing on Wall Street this year, the reason that P/E ratios are compressing is because hedge fund managers are looking at their options and they're saying, should I buy American Airlines stock and bet on the recovery of the airline industry, or should I just lend the money at double digits? Okay, I'm lending money to one of the best airlines in the world, and I'm getting 10%. I can tell you personally, I am lending money to real estate projects for 10 to 12%, and these are money managers that have been managing money for 30 years. They've gone through all sorts of crises, and they're asking for money at 10 to 12% to fund real estate projects. So the answer is, if you're a sovereign wealth fund, or if you're a government or a pension fund, sure, you may need to mandate, tells you that you need to buy government bond of other countries, and you might be dealing with this negative interest rate environment. But for more sophisticated investors, there are many ways to beat this environment, even using bonds and debt. But also with the stock market and with real estate. So I think that the answer is that we are living in this period that's very keen and similar to the 1940s, where interest rates were deeply negative and going higher. And at some point during this decade, because of these supply chain issues and other problems where the world is just now working smoothly, you will have a G7 or a G20 or even bigger meeting where you will have emerging markets and developing markets both coming to try to solve this problem, just like they did with Bretton Woods in 1944. You will need to have some international cooperation. The reason I'm telling you this is because if we don't, then we have a huge problem of deglobalization in the world. And the last deglobalization cycle started in 1910 and ended in 1944, 1950. So during that period of 40 years of deglobalization, you had World War I, World War II, and the Great Depression. So we don't want to go back to that type of environment. There will need to be some cooperation. There will need to be a solution, because an event as global as the pandemic, which should have brought world leaders together to try and solve it, it actually distanced them. And there was a lot of finger pointing and blaming instead of cooperation. So the world has grown apart, and it needs to come back together to solve the problems of the day. If it doesn't, we're entering into a very difficult stage for everyone. So that is the big picture of what's happening, and nothing tells you more about this than the story of Taiwan, which is in the middle, in the center of everything that we just talked about.
So we've gone over what's going on, I guess, energy-wise, monetary policy-wise, geopolitically. So could we conclude with your views on the commodities markets and also precious metals? How will they perform on a relative basis to TINA, I guess? And TINA would be the NASDAQ and maybe also real estate and bond markets in the coming decade.
Yeah, I think that what we're going through right now is a period where the market is realizing that TINA is over, and so interest rates are going to get higher. That's going to put a lot of pressure on commodities and on gold and silver, just like in the mid-70s. But I remind you that just like in the days of 2009 to 2011, when the world said, okay, the Fed's actions are going to cause hyperinflation, gold went to 1900, silver went to 49, there was a lot of bets on inflation, just like there are right now a lot of bets on deflation. A lot of Wall Street money is saying, okay, they are crushing inflation, they're going to get this under control, they're going to raise rates aggressively. And I remind you that once 2011 came around, the world realized that that central banks cannot inflate everything. They do not control the money supply to that extent. And I don't think they will be able to contain inflation. They're able to put a lid on it temporarily. But like I said, you have 80 million Americans, millennials, that are getting married and forming families, they're going to need to buy homes. They have been living in their parents' homes for a very long time. They're getting into better job opportunities because of labor shortage. They have hybrid workforces, so they don't need to live together in cramped apartments in the city very close to their offices. They can go to the suburbs. They can go elsewhere in the country. They will need housing solutions. There will be a housing boom in the United States. There's a housing problem right now just because of everything that's going on. But in general, there's going to be a lot of homes needed to get built in this coming decade. That's point number one. On commodities, and obviously homes require lumber and coppering wiring and everything else. Secondly, with regards to ESG and all of the bureaucracy that is placed on mining, that's going to drive up the price as well. Third, you've got geopolitical problems. The world works most efficiently when there's trust between countries and corporations, and everybody knows the rules, and you can buy from the best and cheapest, especially commodities. But we are not living in that world. China and the United States are fighting over everything, and they're going to make decisions that are not based on pure economics. America will need to ramp up uranium projects. They'll need to ramp up lithium projects that are non-existent in the United States, and they will not source it from other countries because China is going to try and source it, and they're going to compete over those resources. America will need their own independent resources, just like China will, and that's why we're fighting over resources. That's going to drive up the price as well. So these things, ESG bureaucracies plus geopolitical reasoning instead of pure economic reasoning is going to be very good for commodity prices during this decade. But this is only after we finish this era of raising interest rates. Once the Fed is satisfied that interest rates are high enough, that's when we can start seeing commodities going up in price again. For the time being, I think that they're going to be under a lot of pressure. I also want to make sure that people understand this problem of Taiwan very closely, because that's ground zero for any big political issue. So if you want to check out wealthresearchgroup.com/Taiwan, it's a report that I wrote about an area called Malacca. And if you haven't heard that name, if you don't, I see you nodding, so yeah, it means that you do know.
Straits of Malacca, isn't it?
Yes, and it's a very, if you don't, that's as important. So most people don't know that where World War II started, or what was the real catalyst in Poland for World War II. And this is, to me, the same. It's a big problem. It's the size of Pearl Harbor in terms of its the problem size, and most people just don't know this area or this word. So if you download that report and check that out, I think you'll understand better what China and the U.S. are fighting their grand chess match over, because it's not just Taiwan. So that is, in my opinion, the reason that commodity prices are going to go higher. We're not in a smoothly operating world.
And do you think also the negative real yields are going to continue to help gold and silver? And I know gold and silver have had a tough 2.5 years.
Right now, I think interest rates are rising and inflation is coming down. So I think there's pressure on gold and silver, and they're going to be adjusted down. But in general, once the Fed has stopped raising interest rates, which I believe will happen next year, I don't think they will start cutting immediately, but I think that they'll stop raising them. I think that's when you'll see a bottom for prices of gold and silver, and that's when it's going to be the best time to invest in mining companies and in companies that rely on higher prices. But if you're trying to accumulate ounces and build like savings, then this is actually a blessing, because you can buy more ounces for the same dollar amount. So it's a dual. I wear two hats. The hat of the saver likes lower prices for gold and silver. You can buy more for the same amount of dollars. The investor or the trader, he wants a bull market because he can buy mining companies and get exposure that way. So I think that you need to be thinking which hat is best for you right now. Right now, it's better to buy physical and accumulate more ounces. Or if you're a long-term investor, if you have a 2, 3 year, 4 year outlook, and you can sit on a position and let companies grow and start to build positions, you're going to get companies that are real cheap right now. We wrote a very extensive A to Z, like all of the types of mining companies there are. Definitely, if you want to check that out, go to our website, the Wealth Research Group. .com/gold playbook. That's the most extensive online manual on mining companies, all of the different types of them, in terms of like their business model that you can find online that I'm aware of. And you know, in the late 70s, these mining companies, they saw moves that are in the thousands of percent within a year or two. So that opportunity will materialize this decade again. But it's a matter of timing, position sizing, knowing what you're doing. This is not the same as just, you know, dollar cost averaging into America's 500 biggest companies. It takes more sophistication, is what I mean.
Well, that was great, Lior. Before we wrap up, is there anywhere else that viewers could follow you aside from your website?
No, website, and on the homepage, you can subscribe to our free newsletter. That's literally the best way to see everything we're doing in real time.
Great. Thank you very much. And hopefully we'll talk again soon.
Thank you, sir.